Good morning. What are interest rates going to be doing for 2022 moving forward? Hey, it's Robbie Breaux with Robbie Breaux and team. I've got a special guest, Tracy Lasser with Assurance Financial Group or Assurance Mortgage. She's been one of our preferred lenders for a very long time and just an absolute oracle at what she does. So Tracy, thanks for joining us.
Thank you for having me.
Well, so as everybody is starting to see, we're seeing a little bit of a creep up on interest rates. So we've been hearing some rumors, but want to kind of hear it from the horse's mouth, so to speak. We know mortgage-backed securities are stopping being purchased by the Fed, but what else is that? Is that the only thing that's causing rates to kind of climb?
Well, no, and you're right. Mortgage rates have been increasing rapidly since the start of 2022, which is only 18 days ago. And this is the highest rates have been in a couple of years. But reasoning behind it, yeah, what you meant, the push out of buying of mortgage-backed securities and more money flowing into stocks, but higher inflation, promising economic growth, and a tight labor market, or a few other reasons why we see mortgage rates rising right now. And we do expect that this trend will continue throughout 2022, barring no other major pandemic issues or anything else that's majorly detrimental.
Gotcha. So right now, I guess we're middle of January right now, 2022, 20-year, I'm sorry, 30-year fixed rate. Obviously there's a ton of factors. Can you give me kind of a range of what they're looking at?
Yeah, I mean, we're higher than we were before. You may see something closer to the mid threes. It could go up from there too, depending on the overall file profile. So the loan program, credit score, debt to income ratio, loan to value, loan terms. All of those things are major factors when it comes to interest rates.
Gotcha. So I'm obviously a lot of times whenever you run into this, we see people kind of pause for
Yeah.
whatever reason. Probably a little bit more fear based than what's happening. You know, and I think we're kind of a audience, so to speak, for lack of another term, or population, so to speak, that's been so spoiled by something with a two in front of it that they just feel like that's the new norm.
Yeah, everybody wants a two in their rate at the beginning of their rate, and if you wanted that, you should have gotten it when it was still available. You know, Probably the best time was beginning of last year to where the rates really hit their bottom, and you were able to capitalize on a super low rate. But I'll tell you that there are other ways that you can have a positive impact on the overall interest savings on a mortgage. So if you're concerned about higher rates affecting your overall interest cost, consider a few other things. Consider lowering the terms. Maybe if you did a 25, 20, or 15-year mortgage instead of a 30-year mortgage, you could significantly cut down on the overall interest that you would pay on that mortgage. I run amortization schedules for my clients. When I know they're comfortable with and can afford a lower term, I will show them the overall interest savings between all of those options. And typically when you go with a lower term, the rate is lower, but really where the savings is not financing over a 30-year period.
It's the total
So
cost, so to
total
speak.
cost,
All
yes,
right,
because
let's run that. I've got we can go and pull up a little mortgage financial calculator and show folks what that happens to look like. So, all right, and just to make everything super simple, we're not going to get into different types of loan programs. We're not going to get into rural development, VA, FHA, in city limits, out city limits for taxes, older home versus newer home for insurance. So we're going to just take all of that stuff out, take all the mortgage insurance out, and just work strictly principal and interest.
yeah.
So we'll base it kind of like off a $300,000 loan. And right here, I've got it set up at 4.5%, which this was fairly common, 2019?
Yeah, right before the pandemic happened, rates were at a high compared to where they've been over the past few years. And then right after the pandemic hit, that's when they, lowered rates dramatically, and we saw that huge refi boom in 2020. So yeah, I would start with that, and then just, show a good comparison.
So right here we got $300,000. Again, this is you cannot get no taxes, no insurance. Again, disclaimer, or no mortgage insurance with no money down on a loan. But just for comparison purposes and try to keep it simple. At 4.5%, if we're lower or lower mid threes or mid threes is best.
I do mid threes. I like to overestimate sometimes rather than underestimate, just because every day that we've had an open market day, rates have steadily increased. So
Gotcha. So right here we went from at 3.5, we went from 1520 a month to 1347 a month, so about $190 a month savings in total monthly obligation, which seems to be what most folks are driven, is more payment driven from that perspective. So, if you, like you were talking about before, if we're talking about the total number of total amount of interest that was paid, notice right here, and forgive me for everybody checking out. This third column is the one that we want to take a look at. It's the total amount of interest that you pay on the life of the loan. If we get down, 30 years is a long time, you guys. So total amount of interest on the life of the loan was $185,000 if on a 3.5% interest rate. On a 4.5% interest rate, it went to $247,000. So we went 247 to 185. My public school education probably tells me we're in the mids, right at the low $60,000 if you don't make any extra payments on the life of the loan. That's pretty big, man. That's quite a bit of money over the life of the loan. If you run and do the same thing. So you talked about a 25-year term. This one only gives me the option for 20 if we jump down, but on a 20-year term, we save interest. There's a little bit of a cost on the savings on insurance.
On the interest rate?
On the interest, I'm sorry. Is there an interest rate savings?
A little bit. Sometimes 20s and 25s run close in line with 30s. Where you see the biggest interest savings is on a 15 or a 10-year. But still, not that rate isn't important, but you don't, like you said, you don't pay rate. You make the monthly payment. You pay the monthly payment and the overall interest over the loan. So by cutting down the terms, that's going to have a bigger impact than just lowering the rate.
Well, look, we went from 187,000 or 185,000 down to 117,000, which was another $60,000, which is, if we compared it to we went from 245. This is more than half of the savings. Now, monthly note's going to get bumped up a touch, but at the end of the day, what ends up, you went from 1326 up to 1739. Yes, it's a little bit more, but you were chopping down that tree.
You cut 10 years off of your term, and you earn equity so much faster. Something else to note, you may be saying, hey, look, a 20-year payment is way too steep for me. What other options do I have in this increasing rate climate? Well, you know what? Take a 30-year term, but when you can, pay more on the note. So if you were to consistently make one extra principal and interest payment every year on your mortgage, you can knock up to 7 years off of a 30-year mortgage. So that right there is, eating away at the interest, so you're not going to pay as much in interest. You're going to gain equity so much faster, and you're going to pay the mortgage off quicker. But you have the safety net of the 30-year payment. When you can't make a 20-year payment, or when you can't make that extra principal and interest payment, don't do it. But you'd be surprised at how easy it is to make just one extra principal and interest payment per year.
Okay, so that's not counting your taxes and insurance, just your interest.
No, just principal and interest. Yeah. And don't forget, and I know you mentioned this, the calculator that Robbie's showing does not show mortgage insurance. Note that if you buy a home and you use a conventional loan and don't put at least 20% down, there is mortgage insurance in some way, shape, or form. You're paying for it as a consumer. You're either paying for it monthly, you're paying for it upfront, you're financing it in, or you are paying a higher rate to offset the mortgage insurance. So keep that in mind.
Yep. We want to make sure we kept that as simple as possible. So
Yes.
that, you know,
Yes.
while it was an illustration of what's still available to be
Yeah.
able to, as far as savings are concerned, you know, trying to keep it simple, because if we throw different volume, we can
Yeah,
do
I
it
do
all.
want to say one thing about mortgage insurance real quickly is for us, mortgage insurance is now what's called risk-based. So, and we have several different mortgage insurance companies who are vying for our business, which means there's no monopoly. I don't have just one mortgage insurance company to go to. So they all want to compete or need to compete against each other to have the best program and rates. So mortgage insurance is the lowest that I've ever seen it since I've been doing this, and I'm coming up on 15 years in the business. So if you are a conventional buyer and you don't have or don't want to put 20% down, and there are two borrowers, great debt to income ratio, and great credit scores, the mortgage insurance is really low. I have friends who I've helped buy 7, 8 years ago, and then they're buying, last year, this year, they're so worried about paying the mortgage insurance, and I have to assure them and show them the numbers. Hey, mortgage insurance on conventional isn't what it used to be. Let me reprice it for you and show you. I think you'd be surprised. And when people would have before paid $120 a month in mortgage insurance, they're now paying like 30, and they can't believe it. So now they're not stressed out about having to put 20% down. They can buy maybe a bigger house that they really wanted, not have to put as much down, and still keep their payment low. So where interest rates may be going up, mortgage insurance is at an all-time low on conventional loans with really good files.
Awesome. It's a lot of help. And does that apply to like VA, FHA, rural development, all that?
VA, FHA, and rural development have set MI cost. It's not something that you can shop. It's something that has to be bought through each of those entities, and we take care of all of that. But FHA MI is what it is.
Is what it is.
Yeah, VA, RD, the same. It is what it is. Now, programs like VA, if you're a veteran who may have some service-related disabilities, you may be exempt from the funding fee. So VA does not have a monthly mortgage insurance. They have an upfront mortgage insurance, which gets amortized over the full term of the loan. So it's not as big of an impact. But VA has their whole other grid as to what determines the cost of your mortgage insurance.
Speaking of mortgage insurance, this is something that's popping up a good bit. We're in a climate right now where it's a little bit more common for people to buy a home without selling their home. If they're able to qualify for both mortgages. Sometimes not having that 20% down is not possible, but of course you can do 5% down on a conventional mortgage if you're looking to do, purchase a second home, whether it's upgrade, it'll be not necessarily investment property, but for the sake of moving up or the move down buyers. You come in with less than 20% down, you've got the remaining of that equity inside your current home. How long is mortgage insurance in place once the primary house sell, the first house sell, or the
So if someone were to buy then sell and want to take the equity from the sale and do a large cash injection, they can either just do the cash injection and eat away at the terms on the back end, meaning it'll obviously shorten, and just they would do a big principal reduction. Or you can try to do what's called a recast, where you pay a small one-time fee, and it basically resets your amortization schedule. So if you dump $100,000 in, a recast would take that money and lower your monthly payment over the full remaining term of your loan. But going back to what you asked about the mortgage insurance, it's a gray area, which is really weird. My best advice would be have your call your mortgage servicer, whoever you're making your mortgage payment to each month, and before you do a cash injection, call them and say, hey, look, I sold my property. I have X amount of money I want to put into this loan that I just opened with you. What do I need to do? What are your policies in order for me to get mortgage insurance removed? Since at that point I will be at an 80% loan to value.
So this is a servicer by servicer issue, not necessarily
No,
So
no,
not
no.
across the board.
Yeah, it's at the lender's discretion. So whoever you're making your mortgage payments to, they're gonna need to analyze your mortgage history on that loan, and this is why they want to make sure that you have proven that you have made on-time, consistent payments, because mortgage insurance on a loan mediates some of the risk on the loan because you didn't put 20% down. So mortgage insurance backs the loan and the investors against default. So if you remove that, then that insurance policy for that lender is gone. So that's why, lenders, servicers, investors, whatever you want to call them, the company you're making your mortgage payments to, they want to make sure that they don't need that MI on your loan anymore. So they're going to want to make sure that you have a good positive pay history on your mortgage.
Good track record. Perfect. Well, that's awesome.
Yeah.
Well, thanks for stopping in. Appreciate you dropping all those knowledge bombs on us. We really appreciate it.
Thank
Where can they
you for
find you,
having
Tracy?
me. You can give me a call. My direct line is 337-456-8741. You can Google me, Tracy Lasserre, Assurance Mortgage, or tlasserre@assurancemortgage.com.
Awesome. Thanks so much for joining us.
Thank you. Bye.